What if I told you that skipping something as small as your regular coffee could potentially turn into tens of thousands of dollars? Not because coffee is bad, not because you need to become a millionaire overnight, but because of one incredibly powerful idea: consistency plus time plus compound growth. Today, let's imagine putting $50 into a global index fund every month for 30 years, assuming an average return of 8% per year. And then we're going to compare that with something many of us do without even thinking about it: buying coffee 5 days a week. Let's see what happens. Let's say your coffee habit costs you around $10 a week. You buy it 5 days a week, and by the end of the week, you've spent roughly $50. $50 doesn't sound like much. It's one dinner, a few takeout meals, a couple of subscriptions, or in this example, about a week's worth of coffee. But here's where things get interesting. Instead of spending that $50, imagine taking that money and investing it into a global index fund every month. You don't try to predict which company will be the next big winner. You don't try to time the market. You simply invest the same amount every month and leave it alone. After 1 year, you've invested $50 times 12 equals $600. That's it. $600 isn't going to change your life. And that's exactly why people underestimate this strategy, because in the beginning, the numbers look incredibly boring. You put money in, you get a little growth, and nothing spectacular happens. But then time starts doing some of the work for you. After 10 years, you've personally contributed $6,000. But assuming an average annual return of 8%, your investment could be worth around $9,100. You've put in $6,000. The market has potentially added another roughly $3,100. And now something important is happening. You're not just earning returns on your original money. You're starting to earn returns on your previous returns. That's compound growth. Now let's fast forward another 10 years. After 20 years, you've personally contributed $12,000, but your investment could be worth around $29,500. Think about that. You contributed $12,000, but you potentially have almost $30,000. The difference is the growth that happened while your money was invested. And we're not even at the end. Now comes the part that makes this whole example interesting. You keep investing $50 every month for 30 years. Your total contributions are $18,000. That's all the money that came directly out of your pocket. But at an assumed average return of 8% per year, your investment could grow to approximately $74,500. So you put in $18,000, potential investment value, approximately $74,500. That's roughly $56,500 of growth. And remember, you didn't invest thousands of dollars every month. You invested $50. The real advantage was that you started early and kept going. Now let's go back to the coffee. Imagine that instead of investing $50 every month, you spend roughly $50 a week on coffee. That's approximately $200 a month, or around $2,600 a year. Over 30 years, that's potentially around $78,000 spent on coffee. Now, obviously, I'm not saying you should never buy coffee again, and this isn't a perfect apples to apples comparison. The coffee gives you something immediately. You enjoy it, you get the convenience, maybe you meet a friend, maybe it's part of your morning routine. That's worth something too. The point is simply to make you ask, what are the small expenses in my life that I could redirect toward my future? Because $50 doesn't feel like much today, but $50 invested consistently for decades can become a completely different number. And this is what I think is the most important lesson. You don't necessarily need to find the perfect stock. You don't need to become a professional trader. You don't need to stare at charts every day. For a long-term investor, one of the most powerful things you can have is simply time. Because when you invest consistently, your money has more time to potentially grow, and then your growth can start generating more growth. That's why the first few years can feel so disappointing. And that's why the later years can look so dramatic. You're giving compound growth time to work. Of course, there's an important catch. An 8% return is an assumption, not a guarantee. Markets go up, markets go down. Some years can be great, some years can be terrible. And an actual global index fund will have fees, taxes, and potentially currency effects depending on where you live and what you invest in. So don't take this as a promise that $50 will definitely become $74,500. It's simply an illustration of what could happen if you averaged 8% annually over 30 years. So the next time you spend $10 on a coffee, don't feel guilty. Enjoy your coffee, but maybe ask yourself one question. What if I invested that money instead? Because wealth isn't always built with one huge decision. Sometimes it's built with a tiny decision that you repeat over and over again. $50 doesn't look like much. $600 a year doesn't look like much. Even $18,000 over 30 years might not sound extraordinary, but give that money enough time and suddenly the numbers start looking very different. The biggest advantage you can give your investments isn't necessarily more money, it's more time. If you found this useful, subscribe for more simple investing and personal finance videos, and I'll see you in the next one.